TL for the year ended 31st December 2023. So they are giving us a trial balance. We have ordinary share capital, and it is 500,000 shares, each at 1,000, making 500,000 or 500 million, okay? So when you multiply 500,000 shares times 1,000 each, you get 500,000. So the 1,000 shillings is what we call nominal value. Share capital is stated at nominal value in the balance sheet. I want you to record that somewhere, because we shall come across it when we reach a topic called accounting for shares, okay? Share capital is recorded at nominal value. You can't record share capital at market value. So the figure that you normally see that is written alongside share capital, the amount you see is normally we refer to as the nominal value, because share capital is stated at nominal value, not at market value, not at market value. So, okay, we have share premium, retained earnings, plant and machinery at cost, furniture and fittings at cost, equipment at cost, motor vehicle at cost. We have provision for depreciation. Provision for depreciation is the same as accumulated depreciation, okay? Provision for depreciation is the same as accumulated depreciation. Is the same as accumulated depreciation. And then we have trade receivables and payables. Now you will find areas whereby the examiner writes trade receivables stroke trade payables. Okay? At times he may even start with trade payables stroke trade receivables. After that's when it confuses, when it begins with the payables. Okay? Trade payables stroke trade receivables. Now some students, if the examiner begins with trade payables stroke receivables, some students take 84,500 as their payables, which is very wrong. Okay? It does not mean that when he begins with trade payables, the first figure is for payables. No. We should all understand by now that all payables are credits because they are liabilities. Even if the examiner began with trade payables stroke receivables, please, always the credit figure is the payable. Okay? The credit figure is the payable, even if he began with trade payables. I know you'll find such numbers in the question bank. Please don't get confused by the arrangement of the examiner. The examiner can begin with whatever he feels like. Even on purchases and sales, can begin with sales stroke purchases. But it does not mean that since he has begun with sales, now the debit has become sales. No. At least by now, we should all know that all sales are credits, because I've been singing it, okay, right from I think the 3rd class. And all purchases are debits. So irrespective of the arrangement the examiner will use, you should have it at the back of your mind that my purchases are always on the debit side. My receivables are always on the debit side, okay? Hope I'm communicating something. Those are the small mistakes that we shall keep on doing, okay? If at all I don't re-emphasize them, okay? We shall see some numbers are like that. The examiner begins with sales stroke purchases, and you find a student taking a debit as their sales figure because the examiner began by sales. That is totally wrong. By minimum, all sales are credits. Whether a credit or cash sale, it is always a credit. All purchases are debits. Whether made on credit or cash, they are all debits. We have returns. You see that returns were also put on the same line. We have a debit and a credit. Okay, returns, a debit and a credit. So one of them is a return inwards, the other is a return outwards. Now, if I may pose a question, what does 2,500 stand for on the returns? Is it returns inwards? Is it returns outwards?
Inwards.
Very true. These are returns inwards, or what we call sales returns. Because when we are doing journals, I told you sales returns are always debits. Why? Because eventually they reduce sales. Okay? I made that statement. Not once, not twice. Then these 150 are return outwards, or what you call purchase returns, because they reduce purchases. That's why they are credits. Discounts, one is a debit, the other is a credit. What does 2,350 stand for? Which discount is that? Received or allowed?
It is discount allowed.
Discount allowed because it is a debit. We say discount allowed is an expense, okay? So it is a debit, and the other 4,850 is discount received because it is an income. All incomes are credit. Okay, we have utilities, salaries, carriage inwards, carriage outwards, inventory as at 1st January 2023. That is the beginning inventory. We have bank, general expenses, provision for doubtful debt, 8% treasury bills, that is an asset, other investments, that is an asset, interest on investment, that is an income. Okay, so we have that trial balance with us. The examiner wants us to prepare a profit or loss statement and the balance sheet. The closing inventory was valued at that amount. This includes stock 6.5 that is nearing its expiration date. To avoid a total loss, management has agreed to sell this stock at a discount. It can be sold at 4.5, including a sales commission of 1.2. Note 2, trade receivables include an amount of 1.5 from a debtor, Munyazi, who has passed away. KTL's management has decided to write off Munyazi's bad debt and adjust the provision for doubtful debts to 5.5 of the net trade receivables. Utilities paid covered the period of 1st January 2023 to 30th April 2024. Additionally, outstanding salaries amounted to 3.6. Interest on treasury bills remained outstanding, while interest on other investments, 1.5, was accrued. KTL depreciates its assets as follows. Then note 6, the authorized share capital is made up of 600 shares of 1,000 per share. The company issued the remaining shares at 1,200 each during the year. So let us go and see how we are going to do this number. So KTL's statement of profit or loss for the period ended 31st December 2023, and my amounts are in shillings, are thousands, okay? So this is our heading. I said that a title in financial accounting, it must have the name of the entity, it must have the name of the statement, it must have the reporting period, it must have the currency, okay? The currency in which you are preparing financials. Now, the level of precision, these zeros, they are optional. We call it a level of precision. It is optional. You can either maintain all the 3 zeros in your statements, or you reduce the zeros in your statements. And when you reduce, you must indicate up here how many zeros are you reducing, okay? But it is optional. The first 4 are compulsory. Name of the entity, name of the statement, reporting period, and the currency. Okay, so you realize we have sales in this number, we have no, so we shall go by the first format of the profit or loss that we looked at in our previous class. So let's go by sales. You begin with sales. How much are sales? These sales were given. These sales were given, they are on the same line with the purchases, and sales are always on the credit side. Therefore, our sales will be 1560. Then switch off your video.
All right.
It is slowing down my
It's okay.
network. Then please switch off your video. It is slowing down my network. Okay. I think the network is now okay, because videos tend to slow down networks. Okay, now we are starting our computations. We begin with sales. And I was like, sales are always on the credit side, because since they were given on the same line with purchases, we always take the credit figure as our sales, okay, as our sales. So we bring the figure 1560, 840 as our sales. The number has sales returns. Sales returns, you remember we did a number, our first number last time. I gave you all the details that should be in the profit, in the profit or loss statement. Now, sales returns, these were given as returns, and they are giving us both a debit and credit. And we agreed sales returns are always debits because they reduce sales. Sales are always credits, okay? So when there is a sales return, of course, sales are reducing. That's why we are taking the debit, because it is the debit that reduces a credit, okay? Sales are always credits. So when there is something that reduces it, it must be a debit. That's why we are taking 2500 as our sales returns. It will always be a debit, sales returns. So, and they reduce sales. So when you compute that, we get what we call net sales, okay? Net sales. You get what we call net sales. Any questions up to there? Any questions up to that? After that, we go to cost of sales, okay? We go to cost of sales, we compute cost of what? Of sales. And cost of sales, we begin with opening stock, or what you call opening inventory, okay? Opening stock. This was given in the trial balance somewhere, inventory, 1st January 2023. It is 44,300. 44,300. 44,300. This was given. Then we add purchases. We add purchases. Purchases, these were given. They were given on the same line with sales, but purchases are always debits. Okay? 650, 450.
450.
So 650, 450, those are our purchases. If you have purchase returns, we list them and we have them. Okay? Purchase returns, because they gave us returns. One a debit, the other a credit. So purchase returns is always a credit, 150. Why? Because it reduces a debit, which is the purchases. Because purchases are always debits. So if there is any entry that reduces purchases, should be a credit. And that is purchase returns, 3150. 3150. 3150. They gave us carriage inwards. Okay? I told you carriage inwards, this is the transportation you incur to bring the goods you have purchased to the premises. So carriage inwards are here, 2650. 2650, you add it to the cost of the goods. You add it to the cost of the what? Of the goods, because they are in line with the purchases that you made. They are in line with the purchases that you made, okay? In case you have stolen goods, we shall list them, or destroyed goods. In case you have any drawings of goods, drawings of inventory, you also list it from here. I gave them to you last week. So this week, I'm only concentrating on the items that are in the question that the examiner gave us, okay? So we go to closing stock. Closing stock, or what you call closing inventory. This was given in note number 1. When you read note number 1, additional information, the examiner says, by the way, if you are in an exam, make sure that whichever figure you have used, please put a tick. Whichever figure that you have used, put a tick to avoid confusion. Now, in this case, we have already used purchases and sales. We have considered returns, both of them, okay? We have considered opening stock. Please make sure whichever figure you use, put a tick to avoid overlooking for figures. Because for those that you have put a tick, you will not look there again, okay? Note 1, the closing inventory was valued at 64.5 million. Okay, that is our closing inventory. But they are telling you this includes stock of shillings 2.5, 6.5. That is nearing its expiration date. To avoid a total loss, management has agreed to sell this stock at a discount. It can be sold for 4.5. Remember, its cost is 6.5. But since it is nearing expiration date, it can be sold at 4.5, including a sales commission of 1.2. Now, what the examiner is testing is whether you know how to add just inventory as per the requirements of IS2 inventory. Okay? Remember, we did a number last week. The first number we did when I was completing incomplete records, which had a fire that came and gutted the market, and 3/4 of the inventory was destroyed. And the examiner was asking to find the cost of inventory that was completely destroyed by fire, cost of inventory that was partially destroyed by fire, and then the value at which we shall recognize inventory that was partially destroyed by fire. That is May 2018, I think, a certain number. So, and I gave you what IS2 talks about closing inventory. That inventory is measured at the lower of cost and net realizable value. It's what we said, if you remember. Do you remember, guys? Do you remember?
Yes.
Yes, sir.
Okay. So
Yes.
now this is what the examiner is trying to confuse us with. So the examiner is saying, let us go to working number 1. Guys, I was advising these guys that study physical classes, avoid combining your answers with computations, with workings. So normally what we do, if you are doing such a number that has profit or loss and balance sheet, make sure that you leave at least 3 pages, minimum 3 pages, but they can even be 4. Or you can start in the middle of the 4th page, your workings, to avoid mixing your workings with the financial statements, because these workings are just notes to the financial statements. So they shouldn't be in between. Make sure you don't combine your statements with the workings. So now let's go to our workings. Only that I'm here, I can work out from anywhere. So I'll put my workings aside to avoid over scrolling. Okay. So I have my workings here, and my number 1 working, I'll ascertain the closing stock. What is the value of the closing stock that I should take? The profit or loss statement. Okay, closing stock. Now they have told us that closing stock, is how much? Closing stock
64.5.
is 64.5.
64.5, yeah.
So balance as per notes, okay? Balance as per notes. Closing stock is 64.5, okay? But they're telling us within this figure, there is stock, okay, that is nearing expiration, and its cost is 6.5. So the easiest way would be you first less that stock, okay? Less stock, less, can I say, let me call it expired, though it is nearing expiration stock, just to be brief. Less expired stock worth 6.5. What I want to get is the stock that has no issues, okay? I want to get the stock that has no issues. Now, the stock that has no issues will be how much? will be 58,000, okay? Will be 58,000. That is the stock that has no issues. Now, the examiner goes ahead and says, this stock that is nearing expiration can be sold at 4.5, but after incurring 1.2 costs, including a sales commission 1.2. So you can sell it 4.5, but after incurring sales commission of 1.2. That idea the examiner is telling you to get the net realizable value of the stock that is nearing expiration. Okay? So what is the net realizable value of the expired stock? Of the expired stock. Of the expired stock. Remember, net realizable value for those that have attended classes, we said it is equals to estimated selling price, okay, minus estimated sale cost to sell. Costs to sell. For those that have attended this class, these classes, we did even this formula last week. Okay? Net realizable value equals to estimated selling price minus estimated cost to what? To sell. Minus estimated cost to sell. So they are telling us we can sell it at 4.5, but after incurring 1.2 million. After incurring, let me list the zeros because they will confuse us. 4.5 minus 1.2, okay? Giving us 3.3. So this stock can only be sold at 3.3. And you realize 3.3 is lower than its cost of 6.5. And IS2 says inventory is measured at the lower of cost and net realizable value. Therefore, we shall take 3.3 instead of 6.5. Okay? So for you to get now the total closing, for you now to get the total closing stock, we shall get the 5,800 plus the 3.3. Okay? Plus the 3.3, and we shall have 61.6 as our closing, 61.3 as our closing stock. I want to repeat this working. The cost of inventory the examiner gave us, it includes a portion that is about to expire that we can't sell at 6.5. Okay? So the most easiest way is for you to first less this cost of the inventory that you are going to sell below the cost. Okay? You less it so that what remains is the inventory that has no issues. Then you deal with that inventory separately. They are telling us it can only be sold at 4.5, but after incurring in 1.2 as sales commission. It means the net realizable value is the estimated selling price minus estimated cost to sell, giving you 3.3. So now, since 3.3 is lower than the cost of 6.5, and the standard says closing inventory is measured at the lower of cost and net realizable value, we take whatever is lower. In this case, the net realizable value is lower than the 6.5, which is the cost of this expired inventory. So it means we shall take the 3.3 as our cost of what? As our cost of inventory. So that's what you add onto this balance that has no issues to get total inventory. Are we guys together?
Yeah.
Yes, yeah.
Okay. So here now we want to compute what you call the cost of goods sold. Okay. And the cost of goods sold is 632,950. 632,950. The cost of goods sold or cost of sales. Cost of sales. I normally wanted to put it in brackets to show that it is a less. It must be less from our net sales. It must be less from our net sales. So what we get is what you call gross profit. Gross profit is always sales minus cost of what? Of sales. Sales minus cost of sales. Gross profit is sales minus cost of sales. So we have 925, 390 as our gross profit. As our gross profit. But if you have workings that are well aligned, you can just come here and show the examiner. This figure, I got it from working one, from working number one. Okay. If you have computed very well and they are well organized, you just name them, come to your statement, tell the examiner this figure is from working one. Okay, I told you after getting gross profit, we now go to other incomes. Other incomes, we add on other incomes so that we can get what we call gross income. And when you go back to our question, we have other incomes. I saw discounts somewhere. So discounts received is put under other incomes, the 4850. Discount received is always an income because we normally get it from our suppliers, and it is always a credit. And this is what we refer to as trade discounts, okay? Are the ones that we recognize in our financial statements. So for 850, you come here and say discount received, for 850, for 850. We have interest on investments. I saw it somewhere, our last figure, interest on investments. I have interest on investments. Are you seeing it? Interest on investments, it is here. But at the same time, we had a note on it. We shall go and see the note. Interest on investments, it is an income. It's like you have fixed your money and it has come to maturity, you get your interest. You have bought treasury bills, you get your interest, okay? So now, but let's first go and read the note. We saw a note on interest on investment. It is note number 4. Interest on treasury bills remained outstanding, while interest on other investments, 1.5 was accrued. Okay? So interest on investments, other investments, it's 1.5 was accrued. Accrued income is always an asset, okay? I think we can now understand accruals and prepayments. Accrued income is always an asset, okay? And what do we do with accrued incomes? You debit the asset. In this case, we shall recognize an asset called accrued investment income, 1.5, and credit interest on investments. So we shall come and get 8.5, which was given in the trial balance, plus the 1.5 in note number 4. So you get the 1.5 that was given. This was already recognized before year end, but they're telling you in the additional information that there is another 1.5 that was still accrued. And if an income is accrued, it is an asset because you have earned it, but you have not yet received the cash. Okay? If it's a fixed deposit, the period has elapsed, but you have not yet received the cash. So in that case, you debit the asset because anytime you are hoping to receive your cash, so debit interest receivable on investments, then you credit interest on investments as an income. So what we are doing, we are recognizing an income of 1.5, though we have not yet received the cash, but we have already earned it. Are we together? Are we together?
Yes, sir.
Okay. Same note.
Excuse me, sir.
Yes, please.
A question. Under isn't the interest that is accrued included in what has been given to us in the balance, the trial balance?
No, now normally this additional information they give them, but their figures are not included in the trial balance. They're like adjusting information that you have to use to make adjusting entries.
Okay.
Yeah. So in the same note, I'm seeing something on interest on treasury bills, okay? Interest on treasury bills. The examiner had not had given us treasury bills as an investment, 250,000, but we had not recognized any interest on treasury bills in the year. That's why you are not seeing any interest on treasury bills income here. So it is the first time we are receiving it on treasury bills. So come and also recognize it under other incomes. Interest on treasury bills. And we can compute this here. They told us it was still outstanding. They had not yet paid us our money. And they are telling us 8% treasury bills. So it means 8% normally stands for the interest rate, okay, for the treasury bills. So 8% times 250, our investment. 8% times our investment of 250. How much do we get? How much do we get? So we get 20,000. Are you seeing any other incomes? Are you seeing any other incomes? Okay, I'm not seeing any other incomes, but I need to say this. Any number that has an adjustment in the provision for doubtful debts, don't get sure that there are no other incomes until you have computed the new provision for doubtful debts. Are we together? The examiner is giving us a provision for doubtful debts in the trial balance, 2,500. I think you are seeing it here. And he's telling us in note number 2 that one of our debtors called Munyazi 1.5 died, passed away, and management decided to write off his debt. And also management decided to adjust the provision for doubtful debts to 5.5 of the net receivables. Now, it is not until you have computed the 5.5% of the net receivables that we can conclude that we have no other incomes. Okay? I'll explain a bit by bit. So let's go to working number 2. Working number 2, we are computing provision for bad debts or for doubtful debts. Provision for doubtful debts as our second working. Okay? So balance as per trial balance. The examiner gave us a balance as per trial balance of the provision for doubtful debts is 2,500. So balance as per trial balance is 2,500. So now, the new provision we are going to calculate, we are going to compare it with this provision that was given in the trial balance to see whether it is an increase in provision or there is a decrease in provision. If there is an increase in provision, the increase is an expense. It is taken as an expense. And if there is a decrease in provision, the decrease in provision is taken as a deemed income. I repeat, the figure the examiner has given us in the trial balance is for comparison purposes. We don't record it anywhere unless where we don't have any new computation, okay? Where the examiner has not told you to recompute a new provision, then we can use this figure in the balance sheet, okay? But we use it for comparison purposes. By computing the new provision, following the instructions of the examiner, and when we get the new provision, we compare it with this provision to see whether there is an increase or a decrease in provision. Okay, let us start now. The provision for doubtful debts is normally subject or effected on the trade receivables balance. Okay? Now, let us first go to the trade receivables balance. How much is our trade receivables that the examiner gave us in our trial balance? How much are our receivables?
84,500.
Pardon? 84,500, okay? 84,500. So we come here and say trade receivables. These are for trial balance, okay? 84,500. I want to put them in the same line with this provision because we shall just compare it. So it is 84,500. Okay? Now you ask yourself, is there any receivable that has paid me money after year end? Because you will find some numbers in the additional information and the examiner is telling you this receivable paid money, but it has not yet been considered, or it was not yet considered by year end. So if there is any receivable that has paid you money, you have to less it. Okay? You have to less it. Let me put it just to make sure that you remember if you come across it. I will say that receipts from receivables. These ones, the examiner will be very specific that this money was received after year end. It means it was not yet considered. If you have it, please you less. Okay? You less it because our provision is always made on net receivables. Okay? Our provision is always made on net receivables. So if you have any incomes received from receivables, after you have come up with the trial balance, you less it. Then you also less bad debts. You also less bad debts that have been confirmed after year end. And in this case, we have one, Munyazi 1.5. We have Munyazi 1.5 in note number 2. He died and we have decided to adjust our trial balance, okay? So now you get what we call net receivables, okay? You get what we call net receivables. Get what we call net receivables. Now, these are the net receivables that you actually subject the percentage, okay? Now you come here and say, percentage, we call it provision percentage. Provision percentage. Provision percentage is 5.5. 5.5. They told us the new
5.5,
provision is 5.5. Though this one wants to have 5.5. So you set new provision. New provision. The new provision is net receivables times the percentage, okay? Net receivables times 5.5%. This is the new provision. We get the net receivables 83,000. You multiply them with 5.5%. So the figure we get as our new receivable, as our new provision is 4,565. Is 4,565. Then you ask yourself, our provision that was given by the examiner was 2,500. Let me put it here. Our provision that was given by the examiner was 2,500. 2,500. But we are computing a new provision as 456.5. The question is there an increase in provision or decrease in provision?
There is an increase.
There is an increase in provision because the current provision is higher than the previous. You just get it by lessing, okay? By lessing. So there is an increase in provision of 2,065. Now, if there is an increase in provision, this increase is taken as an expense, okay? An expense. If at all our new provision was lower than 2,500 that was given, we would have gotten a decrease in provision, and that decrease would have been brought here as an income. Oh, are we together, guys?
Yeah.
If the new provision is lower than the provision that is given in the trial balance, there is a decrease, and that decrease is taken as a deemed income. It comes under other incomes. You come and say decrease in provision for doubtful debts, you bring the figure. But since it is an increase in provision, because the new provision figure is higher than what was given by 2065, under our expenses, we shall put increase in provision 2065. It is an expense. Guys, are we together?
Yes.
Any questions, guys? Please feel free. Feel free. Okay, silence means we are all good to go. Okay? So it means we don't have a decrease, so I can confidently say that these are the only incomes we had. I've told you where you have to compute a provision. Don't rush to say that these incomes are done. You first compute a new provision, compare it with the old provision to see, because you might get a decrease, and the decrease in provision comes under incomes, okay? So first compute, confirm that it is an increase, therefore it will go under expenses, then proceed. Where it is a decrease, bring the decrease under other incomes. So when you get gross profit, and add on other incomes, we get what you call gross income. You get what you call gross income. You get what you call gross income. So an increase in provision, it is an expense, okay? Therefore, the double entries are very simple. We debit profit or loss. When we debit profit or loss, it means it is an expense. I told you guys earlier, when I debit profit or loss, it means I'm recognizing an expense. And then credit provision. Provisions are always credits. Okay? Provisions are always credits. Credit provision for doubtful debts. It means the provision is increasing. Okay? The provision is increasing. So our new provision going forward will be this one in the balance sheet. Until when we shall recompute another provision to see whether it is an increase or decrease. That's what we do in practice. That's what we do in practice. Whenever there is an increase in provision, the increase is taken as an expense and we increase our provision. Provisions are always credits. Why? Because by definition, as per IS 37, a provision is a liability of uncertain timing or amount. Okay? It is a liability of uncertain timing or amount by definition of a provision, IS 37. So it is a liability. That's why it is taken as a credit. Okay? So after that, we go to expenses. After that, you go to expenses. I'll begin with increase in provision so that I don't forget it. Increase in provision, and the figure is
Provision.
already we have it, 2065. 2065. I can now confidently go to other expenses. And as I told you before, I like beginning with depreciation a lot because most students tend to forget to compute depreciation. So I'll just come and list the assets the examiner gave me: plant and machinery, furniture and fittings, equipment. So I have plant and machinery. Please, in exams, don't abbreviate, okay? Furniture and fittings. We have equipment and motor vehicles. Have equipment and motor vehicles. Now, the examiner is telling us in note number 5 that we depreciate assets as follows: plant and machinery on cost, furniture and fittings on cost. So on cost simply means you get the percentage that the examiner has given you. So 10% for plant and machinery times the cost that was given by the examiner for plant and machinery. By the cost is 450. 450. Okay? And for furniture and fittings, you also get the percentage, 8%. The examiner gave you 8% is here on cost. Okay? 8% times the cost of the furniture and fittings, 36,000, to get their depreciations. Okay, so we shall get 10% times 450 times 450. Then we get 8% times 36,000. Okay. Those are the figures that I'm getting, depreciation on cost. We just get the percentage times the cost of that very asset. Times the cost of that very asset. Then equipment and motor vehicles, the examiner is telling us these are depreciated on reducing balance. So reducing balance, we said, it means depreciation is charged on the net book value, okay? On the net book value. So how do we get the net book value? We shall get the cost of the equipment, which is 60,000, okay? Minus the accumulated depreciation, or what we call provision for depreciation. For equipment, it is 12,000. 12,000 minus 12,000. So this bracket alone gives you the net book value times 20%. Okay? So when they say reducing balance simply means that depreciation is charged on the net book value. You need to first get the net book value, then times the percentage the examiner has given you. Okay? So the bracket alone is the net book value. Net book value is the cost minus accumulated depreciation. So motor vehicle still, you do the same. You get the cost 300,000 minus the accumulated depreciation that was given. Provision for depreciation of motor vehicle is 75,000. 75,000 times the percentage the examiner gave you as a depreciation rate for motor vehicles, 25,000, 25%. 25%. 25%. So 300,000 minus 75,000 times 25%. So you get that as your annual depreciation for motor vehicles. I don't know, guys, whether you started discussions, but please, it is long overdue. Please start discussions. Okay. So after that, we can go to other expenses that are in the question. We can go to other expenses. The other expense you shouldn't forget is the bad debts. Okay? Is the bad debts. Let's go and check whether the examiner had given us some bad debts in the trial balance. Did the examiner give us any bad debts anywhere? I'm not seeing any bad debts. So therefore, you come and only take the other bad debts that was written off at the 1.5. Okay, for who? For Munyazi. For Munyazi. But if at all we had bad debts on the list, we would bring the figure and add on the 1.5. Okay? Because bad debts are always expenses. We debit bad debts as an expense and credit trade receivables. Trade receivables. That's why we list trade receivables here when computing the provision. This is the credit I'm talking about for receivables. You list it. Okay? So you have to complete the double entry by debiting bad debts as an expense. As an expense. Okay? Do we have any other expenses? We have, I'm seeing carriage outwards. Carriage outwards is an expense. These are the transportation charges these are the transportation fees that you incur to deliver to your customers who have brought from you on credit. Okay? In bulk, sorry. 1,820. You have customers that buy from you in bulk. You have to give them transport, and that is the carriage outwards. I saw discounts allowed. Discounts allowed are expenses. These are debits. Discounts are debits. So it is 2,350 as our expense. 2,350 as our expense. Discount allowed. I'm seeing utilities somewhere. I'm seeing utilities. I'm seeing salaries. Let me first list them. I'm seeing salaries, utilities. Then which other? General expenses. I'm seeing general expenses somewhere. So general expenses. And these were given as how much? As 4,600. 4,600. Okay? Now let's go to salaries. Did we have any notes that talked about salaries anywhere? Let's go to the additional information. Do we have any note that talked about salaries anywhere? Note number 3.
Yes.
Note number 3 says,
Note
utilities
number-
paid covered the period of 1st January 23 to 30th April 2020 for those are utilities. Additionally, outstanding salaries amounted to 3.6. So what do they mean? These are accrued salaries, accrued salaries. And an accrued expense is the expense that you have incurred, but you've not yet paid for it, okay? So the salary is given up here, 36550, 36550. We add on the accrued expense, the expense that you have incurred, but you've not yet paid for it. And by now, I know you know the double entry of the accrued expenses. Accrued expenses, we debit expenses because we have to recognize those expenses as expenses for that period, even if you have not paid for them, and credit salaries, in this case, salaries, shall credit salaries payable. Shall credit salaries payable, a liability, because someone is demanding you. Though you have incurred it that period, you have to recognize it, but you also have to recognize a liability. So we shall take a liability to the balance sheet when time comes. Then utilities. For the utilities, they have told us the figure given was how much for utilities? It was 48,000. So 48,000, let us see whether we are adding or lessing. Not 3. Utilities paid covered the period of 1st January 23 to 30th April 24. What do they mean, guys? When you read that note, what do you understand from it?
I think the utilities paid were just covering 4 months, that is January to April. So it's 4 out of 12 times the utilities figure.
Are they covering only 4 months, and yet we are in 2023?
The balance is a
2023 December?
prepayment.
There was a prepayment
It has
made.
been paid in excess.
There was a prepayment because we made a payment in excess. Therefore,
Yeah.
for us, we shall only recognize in the balance, in the profit or loss, we only recognize payment for 12 months, right? Payment for only 12 months. So it means the prepayment is for 4 months, right? The prepayment is for 4 months. So what do we do here? We shall only recognize, remember they had paid for 16 months because in total they paid for 16 months, right? In total. So for us, we shall only recognize 12 months times 48,000. Okay? We shall only recognize, so this is 12 over 16 times 48. So we shall only recognize utilities figure for only 12 months. So the balance is a prepayment. It is an asset that we shall recognize in the balance sheet under current assets. Under current assets. So I think we are done with the expenses, unless we've forgotten any, but we are done with the expenses. Note number 6 affects balance sheet. It is about shares and cash. It will affect balance sheet. Okay? So we have considered note number 5, we have considered number 4, we have considered number 3, we have considered number 2, we have considered number 1. Okay, and I'm not seeing any other expenses. So let us add through our expenses to see. So our total expenses are 240, 212, 240, 212, 240, 212, 215, sorry. Okay, 240, 215 are our total expenses. I normally list these expenses from our gross income. Our gross income to get, our gross income is higher, so we shall get a net profit. Shall get a net profit. Shall get a net profit. So we shall get a net profit of 720,025. 720,025. So you realize what we did last time is the same. What we are bringing in as a new aspect here is provision for doubtful debts. Okay? provision for doubtful debts is what we are bringing in as a new aspect. Whenever they tell you to compute in the additional information, to compute a new provision, please make sure you don't go to expenses without knowing whether there is an increase in provision or a decrease in provision. And the provision is always calculated on the net receivables. When we talk about net receivables, you get the receivables figure given in the trial balance. You less any amounts of money paid by debtors after year end. You less any bad debts written off after year end. Okay, those will be given in the additional information, the bad debts that have been written off after year end. What remains are the trade net receivables on which you subject the percentage of the provision. And the figure you get, compare it with the figure given in the trial balance for provision for bad debts to see whether there is an increase or decrease. If there is an increase, the increment is what we take as an expense, not the new provision. Some students have a tendency of taking the new provision as your expense. No. The new provision is for comparison purposes, and the old provision is for comparison purposes. You compare the two. So the increment is what you take as the expense. If there is a decrease, the decrease is what you take as a deemed income under other incomes. Okay? Any questions before we go to part B? So KTL's statement of financial position as at 31st of December.
CPI, I have a question.
Yes, please.
My hand is up though. Maybe you didn't see it.
Sorry, I didn't just see it.
For me, my inquiry is on a certain justification which I need from you.
Yes.
Yes, I know that bad debts, if we are given bad debts figure in the trial balance, it does not affect our computation as we are ascertaining the provision for doubtful debts, right?
Yes, please.
Now, kindly help me with the justification as to why we don't do that. Just as a justification, but I know that we don't use it.
Now, the reason is because it is already an expense that has been considered during the year. Here, we only consider information after close, because you remember the accounting cycle, actually, it is you who had raised it, that after extraction of the trial balance, don't we do adjusting entries, okay? And I told you it is an option because not that all organizations have adjusting entries, okay, after year end. Some organizations are smart enough to pass all entries before closing the trial balance, okay? So we only consider the ones in the additional information, the bad debts in the additional information, because for them have not yet been considered as expenses for the year. Unlike the other ones in the trial balance, which have already been considered and entered in the system or in the books. So we have nothing to do with them. They were entered before we calculated the new provision, okay? Because the provision is not that you have to calculate it every month or every what. Some organizations compute it at end of every quarter. Some compute it only once a year at year end. So during the year, you'll have bad debts that you'll have to write off, okay? But when you reach time of writing off, and we have some bad debts we had not considered, then that's when we consider them because they are still under our receivables, okay? Unlike the other bad debts already in the trial balance, which were already less from the receivables. These ones are still under our receivables, but we have confirmed they will not pay. Therefore, it will not be fair to compute a provision on a receivable figure having a balance which you already know that they will not pay. Okay, so you need to first less it so that you subject a provision computation on the net receivables. On those receivables, you are sure that at least you have hope that they'll pay. Are we together?
Thank you very much. Jacob had a hand up, but has disappeared.
Yes, thank you, Mr. Masias. My question is about when we are given a corporation tax, do we charge it on net profit or we put it anywhere? Because I've checked in some questions, we have corporation tax.
Thank you. Now, corporation tax, you first get a profit. The profit here will be profit. It will not be net profit. It will be profit before tax, okay? You call it profit before tax. And then after getting it, come here and say tax, then put the tax figure, you less it, and what you get is what you call profit after tax, what we normally abbreviate as PAT, okay? Jacob, are we good to go?
Yes, yes.
Any other questions? Okay, so let's go to the balance sheet. So KTL statement of financial position as at 31st December 2023. Our amounts are in shillings 1,000 still, okay? Still shillings 1,000. So we have done this before in the previous class. So we come up with the assets and we begin with non-current assets. We begin with non-current assets. We begin with non-current assets. After which we shall list them. I don't know whether we had land, but I think we didn't have land. So plant and machinery, furniture and fittings, equipment, motor vehicle. So we shall list them. Plant and machinery. Okay. Furniture and fittings. Furniture and fittings. Equipment. Motor vehicle. Motor vehicle. Motor vehicles. So we shall have a column of the costs. We shall have a column of the accumulated depreciation, which please you have to write in full. Okay, even if you write accumulated and depreciation below, it is okay. Okay, then we have the net book value, which you can abbreviate as well. So on the costs, you just copy the way they are from your question. So from the cost, you just copy the way they are. These were given, they are here. 450, 36,000, 60,000, 300,000. 300,000. Should I proceed? The 300,000, okay, thank you. So accumulated depreciation, if you remember very well, last time I explained it, I told you, when given accumulated depreciation, for us to get accumulated depreciation as at end of this year, we get balance brought forward of the accumulated depreciation, which is given in the trial balance. This is provision for depreciation. You add on annual depreciation that you have computed. So for example, for us to get for the trial, for the plant and machinery, you get your trial balance if they give you provision for that, provision for depreciation or accumulated depreciation. So for the plant and machinery, you get what was given, 45,000, okay? Plus what you computed in the profit or loss, 45,000. So you get your end of year accumulated depreciation. Likewise, furniture, you get what was given as provision for depreciation or accumulated depreciation, 2880, okay? 2880 plus what you computed in your profit or loss, annual depreciation. Equipment, you get what was given, 12,000, plus what you computed in the profit or loss, 9,600. And lastly, motor vehicle, you get what was given, 75,000, plus the annual depreciation you recognized in the profit or loss statement. So that's how we get annual end of year accumulated depreciation. Okay, and the net book value will simply be cost minus accumulated depreciation. The net book value will simply be cost minus accumulated depreciation, and of which, after which we shall get annual total non-current assets. Total non-current assets. Hope we can now understand. The other number we did last week, it didn't have balances brought forward for accumulated depreciation. Therefore, we only took annual depreciation here as our accumulated depreciation as at year end, because we didn't have balances brought forward on the accumulated depreciation. So you just take annual depreciation as your accumulated depreciation. But where you have balances of accumulated depreciation or provision for depreciation, bring that balance, you add on the annual depreciation that you computed in your profit or loss. We go to current assets. Guys, hope you've understood that.
Yes.
So under here we have investments. These investments were given in the trial balance. I saw them as 250. Investments, other investments as 200, as 200. The examiner called them other investments, 200,000. We have treasury bills, These are normally current assets because some of them are 3 months, some are 180 days, depending, but normally they don't exceed a year normally. So treasury bills, 250,000. Okay, we are on current assets. Then we have closing inventory. Normally closing stock, we take it as a current asset, closing stock. But if you remember with closing stock, we had adjusted it and we had gotten the figure 61,300. If you remember, it was our working number one, 61,300. So we bring it there, we bring it there as well. We had the prepaid utilities. Prepaid utilities, if you remember very well, we only considered utilities for 12 months. So for the 4 months, you come and compute it as well. Is prepaid. The one that was paid up to April. So we had 12,000 as our prepaid. I'm meaning not number 2, not number 3, sorry. The utilities from 1st January 2024 to 30th April 2024 are prepaid because they were paid and they are for the next period. Why are those figures for current assets under the column of accumulated depreciation? Now, the organization may not matter a lot, but I normally put them here for organization purposes because I want their end figure to be in this next column so that it can tally with the non-current figure to be able to get total assets. Okay, that's why I don't insert it in the last column. I can either insert it in this column or this column, but I prefer this column that is near to the column where I'll put the total. Okay, so that the total current assets are in line with total non-current assets to be able to get the total assets. Okay, hope you've understood. Then we have remember we had accrued, that is not number 4. We had accrued treasury, interest on treasury bills, interest on treasury bills, Then we also had accrued, okay? Accrued interest on investments. These are assets, okay? Interest on investments. Remember we said accrued incomes are assets, okay? So accrued interest on treasury bills, we computed as a 20,000, so you have to bring it here. Remember the double entry is you debit, I didn't pass the double entry, but the double entry is you debit the receivable. In this case, we debit what we call treasury bills interest receivable, okay? Treasury bills interest receivable. You add the word receivable to show that it is an asset, and then you credit interest on treasury bills. Interest on treasury bills. Now, what we did in the profit or loss is to credit interest on treasury bills, to recognize it as an income, is what we did. But now we are completing the double entry by debiting interest on treasury bills receivable by bringing it as an asset. Likewise, the 1,500 of the investment, it was accrued as per note number 4. So it is an asset still, though we recognize them under incomes. So it is the double entry at play. Okay? At play. Then which other assets do we have? Lastly, I think we have the trade receivables. The trade receivables. Now this is where you have to pay some attention. The trade receivables we bring here are the net receivables, okay? Net of the current provision. Now, the net receivables we had gotten is 83. End of year receivables are 83 because we list the bad debts. So they are 83. So you bring the 83 here, but still you less the current provision, which is 4,565 minus 4,565. So the receivables that go in the balance sheet should be net of the current receivables, of the current provision, sorry. The provisions that go to the balance sheet, the receivables, sorry, that go to the balance sheet should be net of the receivables, net of the provisions, net of the current provision. Our current provision is the new provision, okay? So the receivables that you bring should be net of the current provision for doubtful debt. Okay. Guys, what we are doing right now.
Excuse me, Mr. Masias.
Yes, please.
I think we still have bank.
We still have bank.
Yes.
Oh, sorry. Still have bank. So we still have bank. So our bank, we shall, how much is our bank? We can't see the figure that was given. But I also saw something that will affect bank. So bank is 71,712,750. So we are going to add just this bank. Note number 6 affects bank. Note number 6, what does note number 6 say? Note number 6 says, note number 6 says, the authorized share capital of KTL is made up of 600,000 shares of 1,000 each. The company issued the remaining shares at 1,200 each during the year. So when you go back to the trial balance, our share capital, the examiner told us, it is 500,000 or 500 million, but it is comprising of 500 shares only. So there is a difference between authorized share capital. They are telling us the authorized share capital is 600 shares. So there is a difference between authorized share capital and issued share capital. Now the authorized share capital, this is the maximum number of shares that an entity can issue to the public to subscribe, the maximum. So KTL cannot issue beyond 600,000 shares, but you can issue them in bits. So what KTL did, they first issued 500,000 shares, and then they have a remainder of 100,000. Because when you get to 500,000, compare it to 600,000, it means they had not issued a balance of 100,000. And they are telling us it was later on issued. They issued the remaining at 1,200. So what do we do? Our working number 3 should be about shares, share capital. Working number 3 should be about issued share capital. Issued share capital. Issued share capital. Issued share capital. Now, let me first compute the amount of money received. 100,000 shares, of course, this is what was issued. It was the balance. Okay, to get to 600, it was 100,000 shares times 1,000 each, times 1,200 each, because each they told us it was sold at 1,200, according to note number 6. The company issued the remaining at 1,200 each. The total issued authorized is 600. They had only issued 500 by the close of the year, and they are telling us they issued the balance, which is 100 shares, times the market rate of 1,200, giving us 120 million. Remember, we are chopping off the 3 zeros. So this money normally comes through bank. That's why I told you we have to adjust our bank and add on the 120,000, which is the 120 million. That money normally is paid through bank. So our bank is that total. Our bank is that total. Let me first leave the shares at that. I know we shall have a longer working on that when we reach on share capital. My interest was to first get the amount of money received from the issue of the additional shares. It was my interest. So net assets, you add total current and total non-current to get the total assets. To get the total assets. To get the total assets. Guys, make sure that I'm taking the right figures.
CPA, that figure
Give me
of bank.
CPA.
The figure of
Bank
bank.
figure is it is 712,750. But it is
712.
put 500.
Oh, sorry. 712,750.
750.
Okay. 712,750. Okay. So 1455985. Okay. So the one who was asking why I put these figures under accumulated depreciation, I think you see how organized your statement looks, okay? Than putting all these figures in the last column, you may not be able to add properly and do what. But when you put it here, take only the total here, add the total non-current, get the total assets. You get the total assets. So our next is to get the capital and liabilities. Liabilities. And I request for your attention as well here when I'm dealing with capital. When I'm dealing with capital, I request for your attention. Are we good to go? I proceed. Should I proceed?
Yeah, it's okay.
Okay. At the start, when I was telling you, I told you that capital is stated at the nominal value. Okay? And the examiner here told you that 500,000 shares times 1,000 each. And I told you the 1,000 is the nominal value. But when you go to the additional information, the shares were sold at 1,200. And this is the market value. Whereas shares are stated at the nominal value, we can sell them at a premium. So any amount beyond the nominal value is called share premium. It is a profit. Since the nominal value is 1,000 per share, the value at which share capital is stated, and we sold at 1,200, it means the 200 shillings, the excess of the nominal value, 200 shillings, is the share premium. Are we together? Share premium. Therefore, on this 120 million that was received, there is a portion of the premium. Now, if I'm to get only the nominal value of the share, I'll get 100 shares times 1,000 shillings. If I'm only to get the nominal value, okay, which will give me 100,000 times 1,000, which will give me 100 million. And then if I'm to get the premium, I get 100,000 shares times 200 shillings, okay? And what I get is what we call the share premium. That will give me in total 120, which I calculated initially, because for me, my interest was to get the whole sum money that was received through BAP. It is 120 million, and that's what I added on my BAP, because the money came in, okay? But when we go under share capital, we must split the two. We must split the 120, because it has a portion of the nominal value and the portion of the premium, okay? The premium, you get it by getting the amount that is beyond the nominal value, because the nominal value is 1,000. This was given in the share, in the trial balance, 1,000 per share. So you just multiply it by the number of shares sold. Then the balance, which is 200, is the premium. So when I go to capital, I'll first get the figure that was given in the trial balance, which is 500,000. This figure, 500,000, I add on the 100 million, okay, which is 100,000. So my capital as at year end, it is 600,000, okay? And then share premium, remember share premium is a component of equity. Share premium, they gave us in the trial balance, they gave us a balance. The share premium was a balance of 150, 150. 150,000, I add on the 20,000, okay? This 20,000 here, giving me 170. Then I have retained earnings. I have retained earnings. Retained earnings, these were given in the trial balance as 505,500. 505,500. I add on the net profit. Net profit for the year is 720,025. The one we got from our profit or loss. So our closing capital, our closing total capital will be 199,525. Our closing capital will be 199,525. 525. Then I go to liabilities. According to the question, I don't have non-current liabilities because I didn't see any loan anywhere. Okay, so I'll only have current liabilities. And before I forget, I'll take what we call, was it accrued salaries? We had, I think, accrued salaries somewhere, because we said accrued expenses are liabilities. So you bring accrued salaries. Was it 3.6 in note number 4, note number 3? 3.6. So you bring the 3.6 here. We had the trade payables. We have the trade payables when you go to the trial balance. Trade payables are 5,450. 5,450. 5,450. And those are the only liabilities that we had. So we have 5,7,850 as our total liabilities. So we get what we call total capital and liabilities. Total capital and liabilities, where we shall add the capital plus liabilities. And you realize that our total assets are equaling to the total capital and liabilities.
Excuse me, sir.
Yes, please.
The point where I don't get the total capital and assets equal, that means my computations are wrong.
The point where you don't get these total assets and liabilities equaling to total assets.
Yes.
It means somehow,
Okay.
somewhere, you didn't adjust
Yes.
properly. You didn't adjust
Okay.
properly. And what causes that? I repeat, what causes that are these two animals. Are these two animals. The moment you understand these two animals, you will always balance the balance sheet.
Okay. Thank you.
Welcome. I think we went through it accruals and prepayments in our fourth class, at the end of the fourth class. But I'm going to repeat them before going to the second number. Okay? Because it is something that you need to understand.
Hello, Mr. Matthias.
Yes, please.
I just wanted to get to understand that the prepayments under the balance sheet, in most cases, they are treated. Are they treated as the under current assets?
Which prepayment you have to distinguish. Prepaid expenses are under current assets. Okay? Because when you talk about prepayments in general, a client may have prepaid to you and you have the prepaid income, okay? Or what we refer to as income received in advance. So income received in advance is under current liability.
All right.
Yes, please.
All right.
Retained earnings, where are you lost from? We got the figure that was given in the trial balance. Retained earnings 505,500. On this figure, we add on the net profit for the year. Okay? The profit for the year. If it's a loss, we less that loss from the retained earnings figure given. But since it was a profit, you get the retained earnings that was given, you add on the net profit for the year. Guys, are we done? I want to repeat these two things. I have accrued expenses, okay, and we have accrued income. Then we have prepaid expenses. Then we have what we call, you guys call prepaid income, which personally I call advance income. At times I call it deferred income. Okay. So accrued expenses is the same as outstanding expenses. Outstanding or expenses due. Or expenses due. Guys, are we done copying? This I want to explain. Now, accrued expenses, we said these are expenses that have been incurred but are not yet paid. You have enjoyed the service, but you have not yet paid for them. So to you, the person who has enjoyed the service without paying, it is an accrued expense to you. It is a liability. Therefore, you recognize that expense by debiting the expense and credit the liability, credit a payable, which is a liability. That's why we say that accrued expenses are liabilities, because you have not yet paid for them, though you have enjoyed, though you have enjoyed the service. Okay? It is a liability. Now, accrued incomes, these are incomes that have been earned but have not yet received. You have not yet received them in cash. You have performed the service for them, but you have not yet received cash for them. Okay? For example, you have an audit firm, you have provided audit services, you've even issued a report, but you have not yet received part of the money. So that part of the money you have not yet received is accrued income. It is an asset to you because you have worked for it, you have to receive. You are a landlord, a tenant has slept in 3 months without payments. You, the landlord, that money is an accrued income because you provided a service, the tenant has to also fulfill their obligation. So it is an accrued income. So what you do, you debit the receivable, which is an asset, because anytime you'll have to receive the money, okay? Anytime you'll have to receive the money, and credit the income. Credit that very income. Credit that very income. This is what we have done on the treasury bills and interest on investments. That these are our investments. When the period has lapsed, we expect to receive money. But if they tell us that interest is still outstanding, it means we have not yet received the income. Okay? We have not yet received the income. So what does it mean? That we recognize an asset on that income, at the same time, recognize an income in the profit or loss, and an asset in the balance sheet, current asset. Prepaid expenses, you've made expenses in advance. You have paid in advance. So it is an asset. So you debit the prepayment, okay? The prepayment, or what you call the receivable, because anytime you'll have to use your money, you have made the prepayment, is an asset to you, and then you credit the expense. You credit the expense to reduce the expense figure. Reduce the expense figure in case you have already entered it before, or you credit cash in case you are making a payment first time. You realize on the prepaid utilities, we only considered expenses for that only period. And the excess, we took it under current assets. Okay? This was a prepaid utilities, a prepaid expense. It is a current asset. That's why we recognize an asset. So prepaid expenses are assets. Assets. And then prepaid incomes, you are receiving incomes in advance. It is a liability to the person receiving the money because you have not yet provided a service for it. It's like a landlord receiving money for the tenant who has paid 10 months in advance. To that landlord, that money is a liability because the tenant has not yet utilized it. But to the tenant who has paid in advance, it is an asset. It is a prepaid expense to him. But to someone receiving it, it is a prepaid income, a liability, a deferred. Deferred simply means the landlord will not recognize an income. He will defer the income to the future. Okay? So what you do, you debit the income to reduce it. Reduce that income, you debit it because the money is not yet an income, and you create yes, you debit the income because you have not yet received that income. You debit the income. If at all the money had already been posted under incomes, you will debit incomes to reduce it. If at all you are just receiving it first time and you know what to do, you debit bank because you have received it. But under scenarios whereby you had received it and posted it under incomes, you have to reverse by debiting incomes. Then you credit adverse income, which is a liability. Adverse income, which is a liability. Okay? So when you understand those four animals, I can assure you presentation will not be very hard for you. Okay? Because most of the figures will need to be adjusted, but depending on these four things. Okay? Okay, let's have a break of around, let's come back at exactly 8, question 2, and we go through May 2023, question 2. So let's come back at exactly 8. We shall go through May,
Correct.
question 2, 2023, question 2. And my interest is statement of changes in equity. Okay? Because I told you I'm closing presentation today. We've so far seen how to incorporate in provisions for doubtful debts. Now, statement of changes in equity. Please, guys, practice these things. They are not very hard once you practice them. Let's rest for around 7 minutes. At exactly 8, I'll be resuming.
Amuri. Na mdogo. Timba na utility or guy.
Math 4.5 was stolen from the store but management did not include this in the book. Closing inventory as at 31st December 2022 was valued at 4.4.4 at cost. So the one that was not included, they want you to include it in the books by passing journal entries. And we all know that stolen inventory is normally a cost, okay? It is normally a cost because you have lost it. So what we do, you can set debit profit or loss, or to be particular, you can set debit stolen inventory as an expense, okay? Stolen inventory. But I said, even if you said debit profit or loss, by debiting profit or loss, you are recognizing an expense. 4.5. Tell the examiner that all amounts are in shillings, what? 1,000. Okay, all amounts are in shillings, 1,000. So this 4.5. So we have 4.5. Then we credit cost of sales. You remember, stolen goods are normally listed under cost of sales. Or to be particular, you can say you credit purchases. You credit purchases because we list them under purchases in the cost of sales. In the cost of what? Sales. So that's why I was saying last time that if you have stolen, destroyed, or drawn goods, we list them under cost of what? Under cost of sales. And we also, as we we can resume. We can resume. Okay, we are on May 2023 question 2. So part A, the examiner wants us to pass journal entries for additional information 1 to 8. So journal entries, the format I gave you last week. Journal entries. So we have details. Debit, credit. Details, debit, credit. Details, debit, credit. So we shall read as we pass double entries. Journal entries are the same as double entries, okay? Journal entries are the same as double entries. So note number 1, they say that opening inventory worth 4.5 was stolen from the store, but management did not include this in the book. Closing inventory as at 31st December 2022 was valued at 4.4.4 at cost. So the one that was not included, they want you to include it in the books by passing journal entries. And we all know that stolen inventory is normally a cost, okay? It is normally a cost because you have lost it. So what we do, you can set debit profit or loss, or to be particular, you can set debit stolen inventory as an expense, okay? Stolen inventory. But I said, even if you said debit profit or loss, by debiting profit or loss, you are recognizing an expense. 4.5. Tell the examiner that all amounts are in shillings, what? 1,000. Okay, all amounts are in shillings, 1,000. So this 4.5. So we have 4.5. Then we credit cost of sales. You remember, stolen goods are normally listed under cost of sales. Or to be particular, you can say you credit purchases. You credit purchases because we list them under purchases in the cost of sales. In the cost of what? Sales. So that's why I was saying last time that if you have stolen, destroyed, or drawn goods, we list them under cost of what? Under cost of sales. And we also, as we also recognize an expense in the under expenses. Under expenses. This entry had two figures. The closing stock, they told you the closing inventory was valued at 44.4 at cost. The examiner just wants you to pass that entry. Closing stock is normally an asset. That's why we put it under current assets in the balance sheet. I think you've seen it. I've put closing stock under current assets. Okay? So you debit closing stock being an asset, and you credit trading account. Why do we create trading account? I'm going to show you what trading account means. What trading account means. Okay? Trading account, when you go to your profit or loss, trading account is this. The one that I've highlighted in green is what we call trading account, because that is the section in the profit or loss that involves buying and selling of inventory. Remember, inventory is purely goods that you buy for reselling. Okay? So here, this section in the profit or loss involves buying and selling. That's why we have sales and we have purchases and cost of sales. Okay? So it is what we refer to as trading account. From sales up to gross profit is what we refer to as a trading account. So when you go back to our entry, we have debited closing stock because it is an asset, and credited trading account because closing inventory is list under cost of sales. It is a credit under cost of what? Of sales. So that's what it means by crediting trading account, because you list it under the cost of sales. Under the trading account, it is list. That's why we say that we credit trading account. Are we together, guys? Hope we've understood that entry.
Yeah.
Okay. We are still on note number 2, by the way. The other note had 2 transactions. A check of 12.5 million received from a sale of goods was misplaced and never recorded anywhere in the books. A sale, a check means bank, okay? Received after sale of goods. So normally our bank is increasing, so we debit bank 12.5 and credit sales, because sales are always credits. I think I told you. So when they tell you for journal, when they ask you for journal entries, you are ideally passing double entries. Journal entries mean double entries. Note 3, the company issued additional 200,000 shares at 2,800 each on 20th December 2022. The shares were fully paid for by year end. So here, the examiner wants us to compute how much money we received from the issue of the shares, and to apportion it, that goes to the share capital, and that goes to the share premium. So we go back to the shares in the trial balance. You see the shares were given, and they're telling us 600,000 shares, each 2,500. What does it mean? That the 2,500 is the nominal value, because we said the nominal value is the value at which a share is stated in the books. Okay? And the 2,800 they are talking about here is the market value. So let us compute them separately. The number of shares were 200,000 shares. So if I want to get the nominal value of the share, nominal value of share capital, I'll get the 200,000 shares, okay? I multiply them with 2,500 shillings to get 500 million. And then the share premium, is the excess of the nominal value. I'll get 200,000 shares. What is the excess of 2,500? It is 300, because we sold it at we sold it at 2,800. So the excess is 300, is the premium. So, and the premium is 60. Therefore, in total, we got 560 million. So the double entry will be I debit bank 560,000. Remember, I'm chopping off 3 zeros, okay? Share capital is always a credit. Capital is always a credit. So I'll credit share capital, but I credit it with the nominal value 500,000, and I credit share premium, which is always a credit because it is a component of equity, 60,000. So that is the double entry. Double entry. If you split share capital and share premium, it is very easier for you. Even if you go to the balance sheet, even if you go to the changes in equity, it becomes very easier because you have split them. And splitting them is very easy. When computing nominal value, only compute it by using the nominal value amount, the amount at which the share is stated in the balance sheet. Okay? And then the excess of that compared to the market value, the excess 300 is what we call the share premium. It's what we call the share premium. Any questions? We have computed that in the previous number. Any questions? Okay. After that, we go to note number 4. Note number 4, the company depreciates assets as follows. Here, they just want you to compute depreciation. And we begin with, it gave us motor vehicle equipment and furniture. So we shall debit depreciation, motor vehicle, and credit accumulated depreciation. This is the double entry for depreciation. Okay? Then also the next asset, you debit depreciation. The next asset is equipment and the credit accumulated depreciation for that very asset. And then also the next asset, you debit its depreciation. We debit depreciation because it is an expense. All expenses are debits and credit accumulated depreciation. So how do we depreciate, compute? Motor vehicle, they are telling us 20% reducing balance. And reducing balance, depreciation is made on the net book value. So we go back and see. Motor vehicle, we have 450 as a cost. Its accumulated depreciation is 162. So we shall come and say 450 minus 162 times the percentage the examiner said that we have to depreciate times 20%. Times 20%. Times 20%. So times 20%. So we shall get 450 minus 162 times 20%. Times 20%. So we have 5,7,600. 5,7,600. Equipment, it is reducing balance as well. We get the cost 120 minus 4,3,200. 120 minus 4,3,200 times what figure? Times the percentage of 20 times 20%. I repeat, reducing balance, depreciation is charged on the net book value. And the net book value is cost minus accumulated depreciation. Cost minus accumulated depreciation. Then furniture, depreciation is straight line. You just get the cost of furniture, 60,000. 60,000 times 12%. 60,000 times 12%. Times 12%. 60,000 times 12%. we get 7,200. So here they just want you to pass the double entries for depreciation. Compute it, pass double entries. Those are easy marks. Those are easy marks for you, as long as you know how to compute depreciation. Okay? Note number 5, utilities paid in the year related to a period 1st January 2022 to 30th April 2023, while salaries for the year amounted to 26. Still, you realize this, they are testing accruals and prepayments. Okay? So the utilities paid, we have a prepayment here. We have a portion of the prepayment. So what the examiner wants you is to remove the portion of the prepaid utilities, okay? So you just debit utilities, and the prepaid months were 4 months, okay? Because our year ends 31st December 2022, and yet you paid up to April 2023. So you paid 4 months in excess. So what we do, we shall debit prepaid utilities as current assets. Prepaid utilities as current assets. And the months that were prepaid were 4. So 4 divided by 16, because we paid for 16 months. Okay? So times the figure of utilities, which is 64. Is it 64? 400. 6400. So it is that figure, 6400. So it is equals to 4 divided by 16 times 6400. So the prepayment is 1,600. You debit prepaid utilities and credit utilities. We credit utilities to remove this figure from the expense of the utilities. Okay? From the utilities expense. And these are the double entries we passed here on prepaid expenses. You realize I told you, you debit the prepayment. In this case, it is the prepaid utilities, or you can call it utilities receivable, okay? And credit the expense. So here we are creating the expense since they had already paid them and entered them before, okay? So we are creating the expense, and that is the entry that I gave you here, okay? If I'm just paying them right now, I'll credit cash. But since the figure is already under expenses, I'll credit expenses to reduce the expenses. And on the same note, salaries, they told us, salaries were, while salaries amounted to 26 million. What are they meaning here? Utilities for the year related to a period that and that, while salaries amounted to 26 million. So let's go back to the salaries and see how much salaries were recognized. The salaries recognized in the year are 24,800. The ones that have been recognized in the trial balance, the ones that were paid, were 24,800. But they are telling you the salaries for the year are meant to be 26. It means you have what you call an accrued expense. You have an accrued expense, which is a liability. And accrued expenses, you debit expenses. So you shall get the would-be salaries minus the ones that were paid. The ones that were paid during the year were 24,800 minus 24,800. So to get the accrued, to get that portion of salaries that you have not yet paid for during this year, okay? That portion is 12,100. So you credit accrued salaries, or what we refer to as outstanding salaries, which is a liability. And this is what we said about it. Debit the expense, which we have done. We have debited salaries, and we have credited accrued expenses or salaries payable. Okay? So note number 6. Interest on treasury bills and bank loan respectively remained outstanding. So interest on the treasury bills and interest on bank loan remained outstanding, okay? And they're telling us that investment in treasury bills was made on 1st March 2022, while the loan was acquired 1st September 2022. So these dates will guide us on how many months we have to recognize our interests, okay? So let's begin with interest on treasury bills. Interest on treasury bills is an income. It remained outstanding. It means it is an accrued income. We call it accrued income. So you can call it accrued interest, accrued treasury bills, accrued treasury bills income, which is an asset and credit income from treasury bills, which is an income. Okay. So how much do we get it? They are telling us the investment was made on 1st March 2022. And how much was the investment? You go here and check. Treasury bills per annum, 18%. So it is 18%. We get 18%. We get 18% times 250. This is the annual interest, okay? This is what we call the annual interest. But remember, we are only recognizing interest for 9 months. 9/12. Why 9 months? Because the investment was made on 1st of March. Is it 1st of March? Are they 9, 10? 1st of March, it means March is inclusive. So March, April, May, June, July, August, September, October, November, December. So it is 10 months. It is 10 months because March is inclusive. It is 10 months. So you only recognize interest for the period in which you have fixed. You will not recognize interest for the entire year, and yet you only fixed for 10 months, okay? That financial year. So this is how we shall do it. And the figure we get is 37,500. 37,500. Guys, the reason we are considering only 10 months, it's because of the dates. They told us investment in treasury bills was made on 1st of March. Therefore, when computing interest, don't compute interest for the entire year, and yet you only invested for 10 months, okay? Be very, very attentive on the dates that has been given by the examiner, because it will guide whether that month is inclusive or not. If the investment had been done on 30th of March, of course, March wouldn't have been included, okay? Because it would have been done at the end of the month. But since it is being done at the beginning of March, March is included, okay? March is included. Then interest on loan. Remember, loan is an expense. Interest on loan is an expense. And they're telling us it also remained outstanding, and we got the loan on 1st September. So September, October, November, December, 4 months interest. We had to pay 4 months interest on loan that year. And our loan, where is our loan? The examiner must have given us a bank loan. A bank loan is 24% per annum, 300,000. So you come and compute it. It means it is 24% times 300,000 times only 4 months. This financial year, we shall only recognize interest expense for only 4 months, because those are the only months we utilized this loan this financial year. So 24,000, 24,000. So what you do, since it is an expense and it is an accrued expense, okay, we shall debit interest expense or interest on loan as an expense, interest on loan as an expense, and credit accrued loan interest as a liability, because it is an accrued expense. You have incurred the expense, but you've not yet paid for it. Whereas the first one, you have earned the income, but you've not yet received the cash, okay? So this goes back to what I was emphasizing. Accruals and prepayments. Guys, you will not dodge it. And I told those physical guys, that physical class guys, if you want to pass this paper 70 plus, or even 90, you must grasp double entry, you must grasp accruals and prepayments. Out of that, you may not even score 50%. Okay? And management agreed to revalue lands to 600 million on 31st December. So how much was our land in the trial balance? Land was 5,14300, and they were revaluing it to 600 million. So we are seeing an increase in land, in the value of land. By how much? 600 minus the value of land was 514,300. 514,300. So we are seeing an increase in the value of land from 514,300 to 600. So there is an increase of 85,700. So since land is increasing, you debit land, because when an asset is increasing, you debit it and credit what we call revaluation reserve. Revaluation reserve. Or we normally call it revaluation gain, but me, I like to call it that. This figure, I like to show that it is going to the revaluation reserve. It is going to the revaluation reserve as a gain, okay? As a gain on revaluation. You can put in brackets gain, because there is an increase, so it is a gain. It is a gain. So land is increasing from 514,300 to 600. So we debit land to increase it to the new value, and then we credit revaluation reserve. Lastly, on the journal entries, the directors declared a dividend of 80 shillings 80 per each ordinary share that was available as at 19th December 2022. 40 million of the declared dividends had been paid by year end. So why are they giving us this date, 19th December? Because on 20th, we had issued new shares. I think you remember. On 20th, we issued new shares. So the shares that were issued, they will not receive a dividend because they were issued when the year was ending. It is only these shares in the trial balance, the 600,000, that will receive a dividend, okay? That will receive a dividend. The additional shares will not receive because they were issued on 20th. And they are telling us those that were only available by 19th. So those are the ones in the trial balance. 600,000 shares are only the only shares that have to receive a dividend. And they're telling us each share earned 8 shillings. So how much were total dividends, therefore? So total dividends are normally equals to number of shares. Here, only those shares that will receive a dividend times dividend per share. Times dividend per share. Times dividend per share. The number of shares to receive a dividend are 600,000. Times dividend per share, that is 80. That is 80, okay? Let me first, 600,000 times 80 shillings per share. So in total, 600,000 shares times 80 shillings, giving you 48 million. That is the total dividend that was paid, that had to be paid out. But the examiner is saying shillings 40 million had been paid by year end, okay? Now, dividends are normally paid out of retained earnings. Retained earnings are normally credits because they are under capital, okay? Retained earnings are normally credits because they are under capital. So when you are reducing them to pay dividends, we debit them. So debit retained earnings because you are reducing them to pay dividends. Debit them 48 million because it's the amount of money you have to pay out, okay? Then credit what? Credit the cash because you are paying out cash. You either pay out cash or through bank. The amount that went out was 40 million. That's what the examiner has told you. Now the balance is what you call dividends payable. Dividends payable. You have not yet paid this. So anytime you'll have to pay them 8 million. 8 million. So retained earnings, dividends are paid from retained earnings, guys. Okay?
CPA, pardon, on the 48.
The 48 is the amount of dividends that has to be paid out. How do you get it? Number of shares that are meant to receive the dividends times the dividend per share. Number of shares that are meant to receive the dividend are the dividends are the 600,000 shares, because they told you the dividends that received the share are only those that were available as at 19th of December 2022. And when you read note number 3, we issued the additional shares on 20th December. It means these additional shares are not entitled to a dividend because these are after 19th, okay? So the ones that existed by 19th are these ones we see in the trial balance, are those ones that existed. So 600,000 shares times dividend per share, which is 80 shillings. It gives you the total dividends, 48 million. And those are the total dividends that have to go out. But these are paid from retained earnings. So you debit retained earnings, credit the bank by 40 million, because they told you 40. By end of the year, we had only paid 40. Okay? So 40, credit it in the bank or cash, then credit the liability. Shareholders are still demanding you the 8 million, the dividends payable. Are we together, Dennis?
Yes, understood. Thank you.
Guys, any questions? So journal entries is typically a DAO entries. So let's run through the profit or loss. My interest is in the changes in equity, though I can't do it without getting the profit for the year. I can't do it without, I don't know where you want exactly. So we can't do it without getting profit for the year. When I was starting, I told you I'll do numbers until you get tired.
APA,
Yes, please.
assuming
Assuming
that these dividends that we are delayed to a certain date. Hello? Hello?
please, you're breaking.
No, I was saying, okay, I received the call. I was saying that what if these dividends of 40 million declared were not given a certain date? Am I supposed to combine the 600 shares and the 200 shares to get the dividends payable?
Yeah, in case they had not limited them to a particular date, you combine 800,000 shares times dividend per share.
Okay. But also they have different what? The first ones were issued at a different rate, and then the second ones were also issued at a different rate.
No, the
So
rates are not different.
as I'm combining, which figure should I
Then the
remember?
dates,
Remember, I removed share premium.
the rates are not different. The rates are the same, only that the second, this one it has a component of premium, but its nominal value is 2,500 still. But That's why when we were computing for the amounts received from the shares, I treated them separately. The premium, or the share capital is what was calculated at 2,500 because that is the nominal value. And then we calculated the premium separately to show you that these 200,000 shares are also issued at 2,500. Are we together?
Getting it. The other one was taken, it was income taken in the bank. I get.
Solomon is asking why retained earnings. Because dividends are not operating expenses. Dividends are not operating expenses. And number two, dividends are only issued or are only shared after making a profit, which profit we take to the retained earnings. I think you saw under balance sheet that profit for the year is taken to the retained earnings. Okay? Now that's where we get the dividends from, because a dividend is only declared after we've made a profit. You can't declare a dividend when you are making losses. Now, what do you have to use to pay them? Okay? So we get them from retained earnings because that's where we took the profit. That's where the profit goes, okay, for the year. And secondly, because dividends are not operating expenses, we can't expense them in the profit or loss, okay? Unless if they are preference shareholders whose dividends are expensed in the profit or loss. Preferential shareholders, what you call preference shares. Okay? For them, whether you've made a profit or a loss, you will have to pay them. Okay? Preference shareholders. But ordinary shareholders, we only pay them when we have made a profit. Okay, let's go to the profit or loss statement, which I will not do the heading. Guys, we have only 26 minutes and I have to do these two statements, okay? So let us increase the sum speed. I don't want to exceed 9. So the sales, we can get them. The examiner gave us sales somewhere. Where are they? Sales are 890, 500. Do we have any additional information for sales in the journal entries? The journal entries we passed. Did we get any sales? Yes. Note number 2, we credited sales. Therefore, our sales are the figure that they gave us in the trial balance plus the adjustment, note number 2. Note number 2, we credited sales. We debited the bank and credited sales. There are some sales that they had not considered. So our total sales become 8,9,500 plus 12,500. Okay? Our total sales become 120. Am I really getting the figures right? The one that was given is 890,500. 890, not 89. Okay? So 890,500 plus 12,500. We have sales returns. Sales returns, we less them. Go to your trial balance and check. We have returns, and sales returns are always debits. So 3,400. 3,400 is our sales returns. That will give us net sales. That will give us net sales of those amounts. Then we go to cost of what? Cost of sales. I'm a bit speedy here because we have done the same format this very class. Okay? And we need to beat time. So we have opening stock that the examiner gave. Opening stock that the examiner gave, is it 56,000? Normally I have a book here, physical book here. Inventory as at beginning of the year is 56,000. We add the purchases. Purchases, they were given on the same line with sales. Purchases are 540,800. 540,800. This particular one we have, remember we have purchase returns. Okay, they were given on the same line. Purchase returns, and these are always credits. So purchase returns are 5,100. 5,100. This number is in the same format like we did, almost same details. And numbers will come like this. Okay, so we have carriage inwards. I've seen it. Almost the same details that were in the other number are the same details here. Transport in is carriage inwards, 16,500. 16,500. Then we have closing stock. We have closing stock. The closing stock was given in additional information, and it is 44,400. It is here, 44,400. 44,400. So we are getting 50. We are getting 56. Oh, I'm seeing another expense here. Guys, you first wait. I'm seeing another expense here. Seeing another expense here. You first wait. That will affect. Closing stock was 44,400, but we are going to first consider something else apart from that. When you go to the trial balance, we have, where is it? I could send it somewhere. This stolen goods 4.5, okay? Stolen goods 4.5. When you look at the double entry we did, we said we debit profit or loss as an expense and credit cost of sales. So we shall less stolen goods in the cost of sales, okay? We less stolen goods in the cost of sales. In the cost of what? Of sales, 4.5. 4.5. We less stolen goods, 4.5, and then we less closing inventory, 44.4. That's the figure that I was looking for. But I gave you all these details in the first number we did last week that you have to put. Okay, so we get what you call gross profit. Gross profit. Gross profit. So since this is a cost, I normally put it in brackets to show that it has to be a less. So this, we shall get that as your gross profit. Then you bring your other incomes, same format. We have discounts received. I saw that some discounts. Discount received. Discount received is I saw discounts. Received is always a credit, 4,250. So 4,250 is an income that we have to bring here. I saw some commission received. I saw a commission received. Commissions is 7,540. 7,540. 7,540. We have interest on treasury bills. Interest on treasury bills that we saw that were accrued, and it is 37,500, not number 6. 37,500. 37,500. So these were our other incomes. We didn't have a provision. You realize in the additional notes, the examiner did not tell you to compute a provision for doubtful debts. So like in the other number. So you just go straight and confirm these are the only incomes that you had. When you add them to the gross profit, we get what we call gross income. Okay? Gross income. That will take us to the expenses. Expenses, I told you, I like to begin with depreciation often because students normally forget. And the good thing, we have already computed them. Motor vehicle, equipment, and furniture. So motor vehicle, equipment, and furniture. So since we have already computed them, I'll just bring the totals down here. I'll just bring the computations down here. So these were our other incomes. We didn't have a provision. You realize in the additional notes, the examiner did not tell you to compute a provision for doubtful debts. So like in the other number. So you just go straight and confirm these are the only incomes that you had. When you add them to the gross profit, we get what we call gross income. Okay? Gross income. That will take us to the expenses. Expenses, I told you, I like to begin with depreciation often because students normally forget. And the good thing, we have already computed them. Motor vehicle, equipment, and furniture. So motor vehicle, equipment, and furniture. So since we have already computed them, I'll just bring the totals down here. I'll just bring the computations down here. So equipment is this, and then furniture. Then furniture is this. Okay. I'll bring them that just like that. I have discount allowed. Discount allowed. We have carriage outwards, what they call transport out. Okay. Carriage outwards. So let's bring the figures. Transport out is 14,800. 14,800. Discounts allowed, these are debits, to 3,400. 3,400. Then which other expenses do we have? We have salaries, we have utilities, and other sundry expenses. Salaries, we have utilities, we have other sundry expenses. So salaries, you realize we had a note on it. We had accrued salaries, therefore we shall add the figure. So our total salaries should be 26,000, okay? 26,000. Not, you just get the figure that was given. The figure that was given, 24,800, we add on the accrual, which is 1,600, which is 1,200, sorry. It is 1,200 to get to 600. Utilities, we had a prepayment. Therefore, you get what was given and less the 1,600. Okay, that's why then we get, that's why we credited utilities, we less it. Okay, we less it because they had considered a higher figure, including a prepayment. Sundry expenses didn't have any note, therefore you bring it the way it is, 35,150. You realize this number is almost the same like we did. Only that this number didn't have a provision. They didn't tell us to recompute a provision. Therefore, you don't have an increase or decrease because they didn't tell you to recompute any provision. Then another expense is interest on loan. Interest on loan, which was outstanding in the journal entries. We did it to 24,000. Is an expense. Is an expense that you have to bring forward. And then you complete the double entry of stolen goods. Stolen goods that you credited here for 500, you have to come and recognize them as expenses. Because the double entry is debit profit or loss, and you credit the cost of what? Of sales or purchases. This is what we did in the double entry, the journal entries. So debiting profit or loss means you are recognizing an expense. So come put it under expenses because it has been stolen. You will never get it back again. Okay? You'll never get it back again. So these are our expenses that we had during the year. During the year. Unless if I've left out an expense, guys. Look through critically.
CPA, how about the stolen goods you captured under cost of sales? What were those? Before
The stolen
closing.
goods. This is not number one. Not number one. The examiner told you that opening inventory worth 4.5 was stolen. These are stolen goods. And we passed a double entry by debiting stolen goods as an expense, because that is ideally an expense. Someone has taken the asset, okay, the goods, then credit cost of sales. So what we did under cost of sales is to justify this entry, that you recognize an expense under expenses, but at the same time you less stolen goods under cost of sales. I gave you these details last week, guys, because I gave you all the details, what you have to include in the cost of sales. Okay, stolen, destroyed, or damaged goods, we less them under cost of sales. But at the same time, recognize an expense to complete this double entry we are talking about. Are we together, Dent?
Yes, I've remembered. Thank you.
Okay, so our total expenses will be, guys, make sure that we have considered all expenses. How many assets were we? 1, 2, 3. There were 3 assets. There are 3 assets. Okay. Discount allowed. It seems I took a wrong figure. Guys, discount allowed should be 5,600. I took a wrong figure. I had taken returns. 5,600 is the discount allowed, not 3,400. So our total expenses of 195,010. 195,010. Giving us a net profit. 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 Of 194,580. Giving us a net profit. So ideally what we have done is what we did in the first number. Nothing has changed. This number we have not just computed provision because in the additional information the examiner did not tell us to compute provision. Okay? But the rest are the same. Only that here we are bringing in an element of stolen goods. But I think in the previous number we had stolen goods. I don't know. No, we didn't have stolen goods, yes. So we are just bringing stolen goods here. And in the previous number, we brought in provision. Stolen goods is an expense, like damaged goods. Okay? You debit expenses and credit cost of sales. Cost of sales, because you have to remove them from your purchases. Okay? You have to remove them from your purchases because you don't have them. They have been stolen or damaged or expired. So they are expenses at one At one hand, you recognize them under expenses, but the credit, you credit cost of sales or purchases to remove them from your purchases. I'll only borrow around 5 minutes of your time as we conclude with the changes in equity.
Excuse me, Mr. Matthias.
Yes, please.
Yes, as you have said, we have not calculated for provisions in this number because they have not given us in the
Additional
process.
information.
Yes. So how do we go about this one they have given us in the balance sheet?
This one in the balance sheet is what we shall maintain in the balance sheet. That one in the trial balance. This one, it will be maintained in the balance sheet. Remember, since they have not given us new computations, it means it stands. So therefore, there is no increase, there is no decrease, okay? That's why in the profit or loss, we don't put anything because there is no increase, there is no decrease. Remember, in the POL, we either take the increase or the decrease. Since it is the same, it is zero. That's why we are not posting anything in the profit or loss. But in the balance sheet, this is the figure that will be less from your receivables. Like the one we did here in the balance sheet to get the current assets of the receivables. You get the total receivables or net receivables minus the current provision. Now that is the current provision that will be less from your receivables to get the net receivables to be taken to the balance sheet.
Okay. Thank you.
You're welcome. So now, guys, the changes in equity, as you hear the keyword here there is equity. This is a statement that only shows equity components, okay? Equity components. How about damaged goods with a recoverable value of sale? How do we treat them? Now, I think we did this in the first number where they had given us some goods that were about to expire. And they told us we can recover amount of money. I think Speciosa we covered that in the first number. And we computed the net realizable value. So the damaged goods that from which you can acquire some amount of money, we compute the net realizable value, estimated selling price minus estimated cost to sell. Those figures will be given. So you refer to this very working in this recording. When you are reviewing this recording, we treat them the same way. As long as it is damaged, but we can still get something out of it. We get the net realizable value that is added to the cost of the other inventory. Okay. As you hear the word changes in equity, the statement is biased on only equity components, okay? On only equity components. So for you to do a changes in equity statement, you must be able to understand what are the components of equity. And the components of equity are these items we put under capital, okay? Under capital are what we call components of equity, share capital and other components of equity. So now, after understanding that, you've now seen the number. So each component of equity, of course, it will have a heading. This company is called this company is called Yeye. So you see Yeye Enterprises statement of changes in equity, okay, as at 31st December 20 something, okay, as at. So it is Yeye statement of equity, statement of changes in equity, as at 31st of December 2022. Our amounts are in shillings or thousands. Normally, you realize these numbers of changes in equity, they don't give them a lot of marks, 3 marks, unless if we go to the other topic of accounting for shares, that's when you can see a number, they can give you some good marks, okay? So you need to first understand what are the components of equity that are in this number. One, we have share capital. We have seen share capital is there, okay? We have share premium. So each component has its own column. Have share premium. We have retained earnings. Retained earnings is a component of equity, guys. Okay. We have revaluation reserve. Remember, they revalued land, so we have revaluation reserve. And all other reserves should be components of equity. Okay. If you have other reserves in the number, each reserve should have its own column. I repeat, if you have other reserves in a particular number, each reserve should have its own. Each reserve should have its own column. Each reserve should have its own column. So here we have a column of details. The first column is for details. The first column is for details. The first column is for details. So we shall have as many columns as the items of changes in equity. This very number will only have share capital. You can just get them from the trial balance here. We have share capital, we have share premium, we have retained earnings. But from our computations, we realize, but we also have a revaluation surplus here, which goes to the revaluation reserve, okay? Which goes to the revaluation reserve. So, and you may find a number that has other reserves, okay? Other reserves. So each reserve should also have its own column. Some entities keep as many reserves as they want. Some reserves are dictated by the law in which that entity operates. Okay? Now, like SACCOs, there are some reserves that are dictated by the SACCO, by the SACCO regulations. That you must have a statutory reserve, you must have a development reserve, you must have a share transfer reserve, you must have an education reserve or fund. So it depends on what the regulation talks about, okay? Are we done with coming up with that? Okay. After that, then the first thing you do is to bring forward the balances. Balance brought forward. For the share capital, the balance is brought forward from the trial balance. Share capital, it was 1.5, okay? You bring forward the 1.5, okay? For share premium, the balance brought forward was 300, you bring it forward. For retained earnings, it was 100, 500, you bring it forward. And for revaluation surplus, you also bring forward the balance. It was given here, 11300. 11300. You bring it forward. Remember, you are getting marks for all that. Okay? You are getting marks for all that. Then after you get the total of that horizontal line. You get the total of that horizontal line. Okay? So you first bring forward the balances. So the items here, any item that affects any of those, so we have profit for the year. Profit for the year. The profit that you made during the year, you come and post it under retained earnings. Remember, it finally goes to the retained earnings according to what we saw in the previous balance sheet, that the profit for the year you make, it is added onto the retained earnings. So you also come and bring the profit for the year, the 194,580 under retained earnings, and get the horizontal total there. Because horizontally, that's the total. Okay? Horizontally, that is the total. Did we issue new shares? Yes, you say issue of new shares. Issue of new shares. We issued new shares, remember? And the entry was we credited share capital 500 and also created share premium 500. So 60,000. So out of the issue of the new shares, we had 560. Okay, premium. And you also get the horizontal total there. You just ideally, what you have already computed is what you bring in there in the changes in equity. Okay, as long as that item affects. We had revaluation of land. Okay, revaluation of land. You remember, we had an entry that was affecting land revaluation. So land, we had an entry of revaluation of land, and it was how much? Somewhere, it is here, 85,700. So our revaluation surplus is increasing by 85,700. Okay, 85,700. You also get the horizontal total. We paid out dividends. You look out for those entries you made that affect any of these columns. The dividends, you remember, we paid. We less our retained earnings by 48. Here we debited retained earnings 48 million or 48,000. So you also put it under retained earnings. You put it under retained earnings. And the idea, that's what we do, and then we get vertical totals. We get vertical totals. We now get vertical totals. And those are that is our changes in equity. One, you need to first identify what components of equity do I have in this question. And those are the number of columns you will have. But those that don't always miss are share capital, share premium, retained earnings. Those three, they are always there. The other reserves, it depends on the number. It can have as many reserves as possible. This number has only one reserve, okay? But the other numbers can have as many reserves as possible, okay? Maybe we can do a number of changes in equity and an independent number next class before going to correction of errors. I'll see. But this is simply what a changes in equity account is all about. Get the equity components, give them each column, then bring out those transactions that affected these columns, any of these columns, as you post them, okay, in their respective columns. So when you add this vertical line, when you add that green, should give you the same total when you add horizontally, okay? When you add vertically, it should give you the same total. When you add horizontally, you should get that yellow section. When I add vertically, I must get the yellow section. When I add horizontally, I must get the yellow section. So the changes of equity statement, this is just a combination of components of equity. The share capital, premium, retained earnings, and other reserves. Because other reserves are part of the equity, as long as it is institutional equity, okay, institutional capital. It must be put under changes in equity, because we must know at the end of the day what is our capital that we own as an institution, okay? And this is the same total that shall be taken to the balance sheet. Your equity in the balance sheet should be equaling to this very yellow section, okay? And when we are preparing financials, normally now in practice, we normally begin, after preparing the profit or loss statement, we prepare a changes in equity statement before preparing the balance sheet. Because the changes in equity statement feeds the balance sheet under capital, okay? The information here should be the same information you have under balance sheet of a particular entity. These totals should be the ones that should be reflected in the balance sheet. Okay? Any questions about changes in equity? Depending on the time we shall have, I may do a number of changes in equity. Or what I'm going to do, guys, I'll see whether I share with you a recording that has changes in equity during the week so that you can review it. Okay? Any questions?
Excuse me, CPA.
Yes, please.
I wanted to find out why you've put the dividends under the revaluation reserve instead of retained earnings.
It was a mistake. Thank you. I've also just realized it. It was a mistake. Sorry. It was a mistake. Okay. It was a mistake. Thank you. Any other questions? Guys, I think that's it for today. My advice is one, guys, do as many numbers as you can. I'll not stop singing that because I know that's the only way that you will pass this paper with the marks that you desire. We are not just looking for a 50.